This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
To another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we're very pleased to welcome on Cory Johnson, co-founder and CEO of Pender Capital. We're going to be digging in to the financial side of commercial real estate today, specifically with credit needs and kind of the secondary finance market when it comes to commercial real estate. It's definitely a burgeoning market, especially with, the compression of cap rates that we're seeing, especially with how expensive money's getting and people having a little bit of a harder time kind of coming to fruition on some of their deals that maybe were underwritten back, 2, 3, 4 years ago, and kind of keep sticking to what their, prospectuses might have laid out as far as a general timeline for that. So again, very pleased to welcome on Cory Johnson. Cory, if you wouldn't mind, give us a little bit of background about yourself, and then we'll start digging into the topics at hand.
Yeah, Alex, thank you for having me today. I look forward to it. So my background, really 23 years, both on the residential and commercial debt and equity side of the table. Started my career with Warehouse and Mortgage Corporation back in the early 2000s. Moved from there on the equity side, working for Richmond American Homes. At the time, we were the 9th largest home builder in the nation. And subsequently, got into the financial crisis time. I started up a couple of equity repositioning funds going after primarily distressed public home builder assets, which then morphed into some debt syndication as we saw some needs that were kind of, presenting themselves back in the financial crisis time. Kind of met my partner along the road, a gentleman by the name of Zach Murphy, who's our CIO. And we really focused on kind of the needs that we saw in the inefficiencies in a lot of the secondary, tertiary markets, primarily in, between the coastal areas of the United States. And we really kind of focus on the inefficiencies in that lower middle market as we see them. So it's a little bit different playing field than, I think kind of what's traditionally out there. But it's an area that, we've been in for almost 10 years now. And we really like the opportunity set, which kind of mirrors a little bit about kind of, when we got started on the debt side back after the financial crisis. So it's kind of full circle these days.
Right. And full circle can be good and bad. It's, maybe not the greatest thing that we're coming full circle on some of this stuff, but, there was a lot of lessons to have been learned in 6, 7, and 8 that can really kind of help illustrate to how people can either be protected or start to, underwrite their deals or create other capital investment opportunities for people as well. So, while, there may be some problems that are going to arise, there's also going to be opportunities. To the old adage of when there's blood in the street, buy property, might be a little bit aggressive, but it certainly does kind of, illustrate a point. So when you mentioned that, the specific kind of scope of what you like to focus on being kind of the lower middle market, maybe define that a little bit for our listeners on kind of what the specific market that you focus on would be.
Yeah. So in our definition of the lower middle market on the commercial real estate debt finance side, we really kind of, that's our motion of that is really, loan sizes between, call it 10 and 25 million, maybe 10 and 30 million. So with us, we find that to be an inefficient and rather fragmented segment. When you go upstream and you're starting $50 million, $100 million plus, that becomes a much more efficient marketplace. You've got a lot of the household players, the multinational banks, et cetera, et cetera. So, when you're looking at a $100 million loan request, you're going to have a kind of a stable of lenders that are very active, insurance companies included. On the flip side of the table, you've got the small balance, which, really, more or less is called $7.5 million and down. That's an area of the market that's, historically more dominated by regional players, smaller funds, smaller groups, maybe family offices, maybe some high net worth individuals that are active in the space as they're, kind of driving down the street, something in their local neighborhood. We really like that segment that's kind of in that middle prong. Generally you're dealing with, pretty sophisticated equity sponsors, whether they're, equity funds, single family offices, but it's always been a rather kind of, inefficient segment, because the larger guys find it very inefficient to originate down in this space, because why originate $20 million loans when you can originate $100 million loan? But for us, we like those inefficiencies. And, I think over the years, we've been able to capitalize on those very well. And, ultimately, we're getting very high quality sponsorship groups on high quality assets. Our sponsors just have a different mind frame, and they like to play in this market because they're going after those same inefficiencies as we are.
Yeah. Now, when you would say inefficiency, would you say that kind of is lumped into probably several big groups? Would you say it's mainly focused on just the lack of people wanting to operate in the space, so you have less of a pool of people to deal with, or just kind of the velocity of how quickly capital can get done for people that are actually in the space? Like, I guess the main question would be kind of what is the main driver of what you aim to solve? Is it just availability of capital, or there's some other kind of more granular aspects that you kind of really thrive in that market space?
Yeah, well, I think, really the lack of the availability of capital, number one. And I think it's being highlighted in today's environment because of the regional bank dislocation as well, right? Regional banks account for, most of them, account, a good portion of their balance sheets are in the commercial real estate sector. A lot of that falls within, more or less that small balance or to the lower middle market realm. So you've had serious inefficiencies there, lack of liquidity there. And really even going back to, 18 and 19, when there was liquidity back in the market, it's still a segment that it's not a very clearly defined playing field. When you're looking, primarily we do bridge loans, generally, light lift to mid lift value add. So we're not doing any ground up construction or anything like that. But, when you're looking at, a $20 million loan request that's taking place in like a market, like say like an Oklahoma City, it's not a very clearly defined playing field of who you're going to go to for that opportunity. So, us and maybe a handful of others, are really pretty active on a nationwide basis. And, we've just liked it because, we've been able to kind of develop this reputation. It takes a long time to develop the reputation over time in these markets. But yes, you have this lack of liquidity from the sponsorship groups, and you really look at that lower middle market as a whole, it's actually a pretty sizable segment of the marketplace. It's just, it's been regionally, dominated. I mean, most recent data from Green Street that I've read, regional banks used to account for roughly 58% of the activity in this lower middle market. The new projections are that's probably going to be somewhere, right around 40% or maybe, 39%. So there's a big funding gap that's presenting themselves. So you're getting, equity sponsors that are out there getting, very attractive deals in the new world that we live in today, where the, interest rate environments are different, cap rate environments are different. So there's new valuation, and, without that liquidity coming from the regional banks, private lenders are basically, insurance companies have already looked like they're projected to up their allocations there by another 1 or 2%. But a lot of this is going to be buoyed by the emergence of more private lenders that are going to happen in the space. And I think, groups like Pender are going to be very well positioned to take advantage of that.
Yeah. And, with any space, especially like that, there's going to be different kind of segments in that whole vertical that you're looking at. Mm-hmm. Now, you mentioned that you like to focus on bridge debt. So do you kind of shy away from doing kind of the initial close and origination debt on stuff? Or is it kind of whatever kind of makes sense? Or, if it is specific to one, why do you kind of focus on that area?
Well, no, I think we actually, almost all of our new transactions that we're looking at today are all new purchase money. We really don't have a huge appetite for recapitalization at the moment, unless a equity sponsor can bring significant, new dollars in fresh into the deal to kind of get the, the loan to value requirements to where we feel comfortable with lending. But really what we're really focused on, again, is, as we're dealing with these equity sponsors, and, maybe they have, say, 10 LOIs out at any given time as they're looking for, attractive, new purchases. They're, if they procure 2 of these deals a year, maybe we get the financing on 1 of them. And, that's a nice place for us to get that repeat business cycle going. Most of our projects are, most of the value add. I mean, think of value add in our definition. I'll give you a quick, dirty example. You have a sponsor buying a 200-unit apartment building, maybe the ugly duckling on an otherwise good street, good neighborhood. They're buying it probably somewhere near stabilization. But, historically, if you go to a perm lender, they're not going to want you to destabilize that NOI. They're going to want it to go in. They're going to want to see you kind of destabilize and start, releasing, units. So most of our sponsorship groups, they're coming to us. They understand that we understand their business very well. they're going to go in, hey, we're going to destabilize, 20% of this project at a time. We're going to make, interior improvements to the units. We're going to make improvements to the common areas, to the exterior of the building. We're going to do this on a rolling basis, for the course of, take 12, 18, 24 months, whatever it may be. And then ultimately, as we've got these new lease, this increase in NOI, now we're stabilized, then we can go look for, traditional permanent financing or potential property sale. So that's kind of the genesis of the majority of the sponsorship groups of, using our type of bridge debt.
Yeah. Now, would you say that that kind of plays into the opportunity that you see as well, is that maybe the general idea of a sponsor coming in and wanting to do that kind of fragmented destabilization of the asset that might otherwise have been kind of in a stable platform as far as like the cash flows go? Is that something that the more traditional lenders, with them being less in the space, as you mentioned, is that something they typically shy away from? And does that, again, kind of drive the opportunity that you see in this market?
Yeah, and I think that kind of holds true to kind of, even again, my example earlier when liquidity was more prevalent in 18 and 19, it still goes back to, when you're looking at if you're a bank underwriter, if you're a Fannie or Freddie looking at something, they don't want to see that NOI destabilized at all, So these groups are coming to us because they see some sort of value add opportunity within the asset. Now, I think today's world that we're living in is a little bit different because you're seeing obviously the different levels of distress, the different valuations, obviously the interest rates of where they are. Any project that was originated in, pre 2022, is a much different valuation metric today than it was back then. That's another reason why we like the short-term duration of our loans, because we're able to kind of quickly get in and out and be a little bit more nimble rather than having, 5 to 7 year maturities that, you could have underwritten it, at say a 60% loan to value initially, that could effectively be, closer to 90+% in today's world. So we like kind of being able to reset, our exposure on kind of what today's world really looks like, because none of us have the crystal ball, but ultimately the way we look at the world is that V in the loan to value equation. That's how we protect, investor capital. And ultimately we're very cognizant of what the takeout market is looking like. We don't want to over leverage an asset for a sponsor that may have to then, say 2 years from today, bring additional capital, to the table in a stabilized market to get their deal refinanced. So we want to be cognizant about not stringing people, really out to dry on these deals, and that's, I think, been a very beneficial for us and with our sponsorship groups. They're able to they understand how we underwrite, they understand what they're going to have to bring to the table, what they're going to have to do to procure this project, and most of these guys, they're all professionals. They're professional groups. They have large balance sheets. This is what they've done in multiple cycles. And that's really the focus area that we're in. We understand that, and they understand, more generally speaking, that if they want to spend, 6 extra months, they can probably procure financing that's maybe a bit cheaper, but it's going to come with some caveats, right? I think one of the challenges the regional banking world has today, and I think this kind of goes across the board for the banks that are active, is the first question almost out of everyone's mouth on the banking world is, okay, well, you're looking for X amount of loan. How much can you bring over in the way of deposits? And because everyone's trying to recapitalize their balance sheets. And, I think that creates more inefficiencies for lenders like us that aren't depositories to be able to provide even more, you might be paying a little bit more on face value of the rate, but you don't have this idle money sitting by that you can't really touch if you go throw it in deposits. So it's kind of, an interesting kind of nuance to kind of what's happening today that maybe wasn't happening about 5-6 years ago.
No, for sure. And to the point of kind of, your strategy on the velocity of your capital and the turnover that you have with it, what's typically what you kind of like, what's your Goldilocks zone for trying to, operate in this space with what you do for how you underwrite these?
Yeah, I mean, in a perfect world, we're in and out of deals, under 24 months. I will say though, Alex, in the new world that we live in today, it's been very interesting. If we have a sponsor that thinks they're going to be in and out of a project in, say 14, 15 months, they're all asking for 2-year terms. And largely that is due to the basically the lagging velocity of the perm market to actually get those refinances done in a timely manner. Give you a quick example. Yeah, historically, when we got payoff demands from our sponsorship groups, from their new lenders, payoff demand, most of those would kind of pay off in the 30 to 45 day range. Today, we're looking at, we get a payoff demand, internally, we're thinking that's probably going to be somewhere in the 4 to 6 month range. It's not much slower these days to get that permanent financing taken care of. So that's, sponsorship groups are having to bake that into their pro formas as well, that you're going to have to carry, maybe this more expensive bridge debt for, an additional 4 to 6 months longer than you probably historically would have. But, I think it's kind of, I think they're compensating that with the way they're purchasing the assets. And we've seen some very attractive purchases take place from our sponsorship groups. And, from us, from the debt perspective, you look at kind of where the market was, say in, 2019, where, groups were asking and getting, 65, 70% loan to values from groups like us. And from other groups, they were getting even more higher advance rates. Today, that same deal, we're probably lending 55% on it. So it's just, it's a different whole enchilada, if you want to put it that way, of kind of what the lending world looks like. The covenants are back in full force. And, again, it just goes back. There's just fewer options out there. And I think, groups that are well capitalized are going to be able to procure very, very high quality sponsorship deals with very high quality assets that are trading. And, we still believe that there's going to be, further, dislocation in the water as a lot of the banks have to eventually remark and probably remarket some of these deals. I think there's going to be some more velocity there. So, a lot of our groups, our equities partners, a lot of them are very cash rich right now. They sat around, for several years, kind of after COVID, trying to figure out what was going to happen. They didn't feel comfortable with kind of where the cap rates were. So they're really, very active at the moment, really looking for some nice risk adjusted returns and, seemingly starting to get, more and more of them as we're seeing really more of that bid ask kind of come in. It's, a lot of sellers that, really seemingly were kind of holding on. And I think, if you look back to, I think it was like December 11th, December 12th of 2023, when the Fed came out and basically said, hey, look, economy's doing well. We believe, we're going to probably be able to cut rates, in the upcoming year. Oh my gosh, this wave of optimism kind of spread over the real estate community, right? And so groups that, were probably already kind of baking in some of the potential losses that they may have to take, it kind of everyone paused for, 60 days and said, well, instead of losing all my equity, I might only lose a portion of it or maybe none of it. So it kind of stalled all the transactional volume there. I think people have kind of come back to life a little bit, over the last, call it 60, 90 days, and understanding that, hey, we're probably going to have to move out of these assets because we don't believe there's going to be any significant, rate reductions here over the next year. So again, it's kind of picking up sales velocity in, portions of it. But as a whole, I mean, the velocity and the transactional volume has been way down. But it's nice that, we've got enough active groups out there that it's kind of filling up our pipeline pretty well.
No, absolutely. And I've definitely seen that from my end of things too, with just, some groups that, you see kind of, most of the stuff kind of come in waves and it ebbs and flows. But a few of the groups that I, kind of fall into that avatar of, very experienced operators that have put a pause on stuff up until, the, new year. And then they're kind of looking at it. I've seen some massive stuff come to fruition in the past like 2 months with some of those groups. So you're definitely kind of starting to see it from that perspective. Now, notwithstanding some of the really interesting things that I have seen from why some of those deals have come to fruition. I saw one that just literally had a larger Wall Street commercial hedge fund, back out of their financing covenants just from what we think, just so they could have a paper loss. Literally just wanting to manufacture a loss with this stuff, which can, again, I would like to think that that's not going to be a norm for any form or fashion. I mean, it's probably better to invest money and make money than lose it, but I don't sit on Wall Street. Maybe they are smarter than me, and there certainly are people out there that are. But it's when turbulence occurs, there's going to be interesting things unearthed everywhere. It's those rocks get turned over, and you start to see a lot of stuff, and that opened up the opportunity for I want to say it was 190, maybe 200 doors that was penciling in like a closing cost of somewhere around like the 30 million mark. And it just got dumped on their door for almost pennies on the dollar for what needed to come in to, refi the other people out and capture that deal. So it's a lot of interesting stuff is going to happen. Now, from your perspective, you're talking about how these deals are kind of penciling on the equity side a little bit different. Now, is it just as easy as kind of a low-hanging fruit to say that a lot of these sponsors are coming in and trying to have more skin in the game? They're trying to, raise more capital from the onset so that loan to value from the rip is going to be more favorable. So, what are some of the things that the equity side that you're seeing is doing to combat what's currently going on in the market?
Well, I think you just hit a lot of it on the head. I think the days of the loose money are more or less at a huge pause. I'm not going to say it's not going to come back at some point, but when you've got the vast majority of the lenders or financial partners on the other side of the table, that none of us really have any desire to go too high up in the capital stack on the leverage of the advance rates. These guys are forced. The equity sponsors are more or less forced to raise more capital. They need to keep their ratios in line, not only from bridge lenders, but definitely for the perm lenders to have that make sense. You're seeing more. I think we're seeing more ask for actually like preferred equity than we've ever seen. We don't do a whole lot of that. A very, very small percentage of what we do is in that space. We're really focused on the senior position. But again, if us being the senior position right now, I think our weighted average loan to value of our entire portfolio is at 56% senior positions. So just by that nuance alone, they're going to have to raise more equity to come to the table. And, they are. And, I think the really good equity sponsors out there, they have that availability to go raise that. They can get their numbers in line. And it really goes back to where they're able to ultimately, hey, we're going to raise a little bit more equity. But, the way they're buying these assets today, they're being able to kind of make up and then some. And then if they get any, if there's any good news that happens in the space, if rates are cut at all, or any, really the way they're looking at it is any like positive leasing activity on some of these deals, they're already in the money, and then everything else is kind of just bonus on top. But without a doubt, across the board, I think every lender is requiring much more equity to come to the table. So it's forcing these guys. And again, it's kind of, I think it's kind of, thinning the herd, so to speak. You're going to have the groups that are well capitalized, both on the debt and the equity side of the table, that are going to be able to really, truly take advantage of what's happening here. I think some of the groups that aren't as well capitalized, unfortunately, they're going to, miss out on, some of the real, benefit of kind of some of the dislocations here. And again, I'm speaking more specifically to the lower middle market space. So again, the check sizes are a little different. Obviously, if you go down to like the small balance space, hey, there's, different things that happen down there, and, not bringing in as much equity. So there's still going to be a lot of transactional volume. But I think without a doubt, I think this is going to be the new norm for the foreseeable future, that, sponsorship groups are going to have to bring more money to the table just across the board.
Yeah. And again, I think from a, general perspective, I mean, it might be a little bit more of a hassle to raise more capital, but I think from a multitude of different perspectives, it's going to create a much healthier market space. It's not hard to conceptualize it, and it was certainly very well illustrated in 2006 and 2007 that a market that has almost zero appreciable equity is ripe for something really bad to happen. You're gonna be much more incentivized to stick it out and make it work and be a good steward of your client's capital when you have so much skin in the game, as opposed to, hey, we're coming into this at a 10, 15%, initial LTV. And what's going to happen when everything starts to go the way it did? I mean, granted, I don't think it necessarily will, but it's easy to see.
Well, it's funny you bring that up, Alex. I had a conversation back, and this is probably, end of Q3 of 2019. Like, we were on a stretch that for 45 or 60 days, I don't think we could win a deal to save our lives. And it was interesting. It wasn't because we were more expensive, and, on occasion we are, and this is part of the business, that's fine. It was because we would not advance as much capital. We were, say, maxed out on a multifamily deal at, say, 70%, and we were losing because people were on the debt side going up to 85%. And I remember I called a couple of our larger LPs, and I was explaining to them what was going on. I said, look, in our minds, we're seeing groups that are taking equity type risk for a debt type return. And fundamentally, it doesn't make a whole lot of sense to us.
Mm-hmm.
So it was interesting as kind of you saw, again, there was a lot, I think there was like 4 or 5 pretty large funds that closed around that period of time. So they were just, trying to pump capital out. And it kind of balanced itself out after that, 45, 60-day mark. But it was just really interesting. You see that kind of that easing of, of the money that kind of into the system. Now, I mean, it's just a totally different world. And I'm sure there's going to be a few groups that come in, try to take advantage of that, really try to juice their returns. But the other thing, we're really seeing across the board, and this kind of goes back to the regional banks, kind of, pulling back, pretty heavily. But if you look at, I read something the other day, and somebody was worried about the, how much money is going into private credit. And oh my goodness, there's so much money going in, this is going to create this frothy market. But if you really look at it from the, really from the risk perspective, right? Most of the private credit lenders at the max, right? They're generally having, 1 turn or maybe 2 turns of leverage. We operate at, sub 25% fund level leverage. So we're really on the other side of the spectrum. But, you look at the traditional banking sector, they're levered 6, 8, sometimes 10 times to 1. So if you're looking kind of, what it could do to the system long term, I actually think, in some ways, the private credit market is going to be a little safer down the road than it is today. Of course, there's, if you have too much money pumped into anything, the underwriting standards generally will loosen up a little bit for people to deploy capital. And that's an unfortunate byproduct of it. But I do think that the market as a whole will be in a better position. But it just goes back to there's only so much that these real estate projects can absorb from a rate perspective, right? They're either you're buying it at a level that you can withstand this higher cost of capital. But, those groups that were caught, hey, I got into, that 3-cap deal and, I was a little underwater on my financing then. And now that deal is expanded out, I'm completely out of the money. Like, what are you going to do? So the only logical thing that happens there is, the next time that property trades, it's going to have to trade at such a discount that it puts everything back in line. And I think that's a fortuitous part to be if you're on the new origination side of debt like we are, because we're able to capitalize on these new valuations. It's just, it just mounts that, if you got that call it, 2022 exposure, it is a different world. It is an absolutely different world up there.
Yeah, and speaking of the different world out there, especially when it comes to the contextual comparison between, the large institutional people, your Fannie Freddies, your larger institutions that come in and do these, what kind of benefit do you see from rising rates? I mean, again, like you said, in any market, there's only so much cost increase that anything can absorb. It doesn't matter if you're buying a loaf of bread, looking at eggs, or you're looking at commercial real estate financing. There's only so much, on one end of that equation that can be absorbed by rising cost of whatever it is. Now, how does that kind of play in to what you do? I mean, you can't necessarily, like you said, like price it, so much more expensive, but you're not going to want to try to undercut the market and be like, well, we're going to be cheaper. Well, if the institutional guys are at one price, we're not just going to leave money on the table. So how do you kind of navigate that? Because that's something I'm always interested in hearing from, especially the debt side of the equation, is how do you kind of navigate what your price markers are for this?
Yeah, I mean, it really, again, it goes back to, if I'll say, Alex, you'd be surprised, right? I talked about kind of the loan submissions that we get, north of 900 million a month. I'd say probably 200 million of that is like that. It really looks like rescue capital to me. It looks like, we are just throwing something at the door, see if anything sticks. And you can kind of filter through that pretty quickly, right? I would say probably on the lower side of the cost spectrum for borrowers, because, our kind of thesis is, has always been principal preservation first, yield generation second for our investors, right? With that, though, they understand that for us to, get outsized returns, we have to do it one of 3 ways. It's either you're going to put additional leverage on your fund, basically fund on fund level financing. You're going to go lower in the capital stack doing mezz or pref equity, or so they're nuanced. or you're going to diminish the borrower quality on the back end, or some sort of combination of the three, right? So we're really focused on really, hey, we want that senior piece, will be a bit more cost effective to the borrower on that, because we want those better quality sponsorship groups. And we want their velocity of getting in and out of projects. That works really well for our business model and the way we originate loans. But you are seeing, certain groups that, you will see a deal like, oh, well, these guys are giving us this amount of leverage, but this got this extraordinary rate on it. And I'm like, the way we're looking at it, that everything has to work so perfectly on that for you to get paid off as a lender, number one, and also for that sponsor to actually get out of this in the money and not have this, in some sort of litigation down the road. Because again, there's only so much these things can handle. And again, there's lending groups out there that, kind of have that old, call it, lack of better terms, that hard money quality, that, loan to own. That's not what our investors are coming to us for. That's not what we're, want to be out for our partners. We want to be a nice partnership group. I think we've got 34 repeat borrowers, sponsorship groups that we deal with, right? They are very programmatic with their capital, in and out. So while they're bringing us something, we're looking at it, well, hey, I see that you think this is going to be great for 2 years. What happens if it takes 3 years? Can you withstand that? And I think that's when you've got to be very, I think, in tune with what the market's doing. We don't, we stress test everything, that if, hey, rates are probably going to go up, hey, 100 basis points, what does that do to this borrower? What does that do to this project? Do they have the ability to withstand that pain for an extended period of time? And I will say, on I think some of the non-favored asset classes, outside of, multifamily or industrial, or even storage for that matter, you look at kind of, the office market, the retail market, the hospitality market, we're really starting to see transactions that bid ask is now coming into levels that some of these sponsorship groups are buying at levels that basically can withstand even call it a higher cost bridge debt almost indefinitely. And that gives us a little bit more comfort, because that takeout market's not as clearly defined and established right now as what it once was. But on that same note, we've seen some projects that, kind of what you described as, that one that somebody bought it at pennies on the dollar. We looked at a deal recently that, the sponsorship group was effectively purchasing it at something like 15% of previous valuation. And we looked at the deal, and still, it was kind of like a, second, third tier office building in a major city that's a challenged major city. And we just could not get comfortable with, like, even if our exposure was, sub 10% of the previous, valuation, I just can't get comfortable with it. So you definitely got the gaps and the voids around. And I think, people are just having to get creative. Luckily for us, we see a lot of deals that we can kind of use negative selection to get into the deals that we feel offer us the best risk adjusted return for our clients. And, we're pretty forthcoming with the sponsorship groups, it's like, hey, this looks like on paper, this is a terrific asset or a terrific trade for you. It's just not the trade for us. And I think, the ability to say no in these environments, because a lot of these things look really good on their surface, but, we are skittish in certain markets, certain municipalities, the challenge, I think, for some lenders too, it goes back to the enforcement of the letter of law. And I think certain states, were really good to lend in previously. And I think since COVID and what's happened in some of these cities, it's become much more challenging for lenders because, your enforcement rights don't feel like they're at the same levels that they once were. So you've got to be a little bit more selective on kind of where these assets are. And I think that's, maybe our just internal take on that. I know there's groups that are still very active in some of these other markets, but it's just kind of, where we feel comfortable. And, ultimately, back to the kind of your initial question on that, it just goes back to, we have to feel comfortable with our borrower's ability to exit. And if we're not comfortable with that, and there's any question about that, it's probably not the deal for us. And ultimately, some of our sponsorship groups, they even ask us, like, well, why aren't you guys as comfortable with this? We give them a few of the reasons why. And, sometimes that's, you're probably not too far off. We still feel confident about what we're looking at, but, maybe there's something out there that's even better. And so it's just, we like to have that open communication with our sponsorship groups. And, we'll just flat out tell them, we think, if you do this deal with us, we're concerned that you're going to have to bring maybe equity to the table for a permanent, financing. That doesn't make sense for us. We just don't ever underwrite that way. And I think a lot of our guys will appreciate that. And, hey, we're going to lose a lot of deals because of it as well. And you know what? That's fine.
Yeah, and I think kind of going back to your point, and this is something that you can probably distill down that, no matter where you are kind of as an investor in the debt stack of real estate in general, is, maybe trying to avoid that, equity level risk with the debt level return. I think that's a really good, statement to make, is that, especially in this market, don't try to chase it too much. Stuff will pencil, but you have to be patient with it. And that's, what a lot of people have been so used to is kind of getting past that, that mental shift of like, for, the past 3 or 4 years with the way that debt was, it's hard to make something. Some people, you kind of had to try to make something not pencil out. It was very easy, and I'd say that with a bit of a grain of salt. But comparatively now, it was extremely easy to get something that made sense, whether you were going to be doing something that was commercial stabilized from the get-go, something that you're going to be using bridge debt to get into more permanent debt with. There was a lot of different ways to make money, and so long as that you had for the most people, as long as you had a pulse, and you were operating, it wasn't. You could look like you really, really knew what you were doing. And that's part of what frightens me here. And I'm curious to maybe get your perspective on where you think the biggest opportunities might lie in kind of this new inventory that is going to be coming from somewhere. Either people that are going to have to be selling these things at a loss, either people that are going to be going through the litigation aspect, and borrowers that are going to be basically getting large commercial REOs on their books. Like, where do you kind of see the opportunity for the equity side, and how does that kind of play into the debt side of things? Are these things going to be deals that are underwritten any different, or is just, do you really just see it as kind of a higher inventory play for the sponsors that and trust to kind of go out there and capitalize on?
Well, I think you hit a really good point, right? I think, a good market, and a market that's ran up as long as the last cycle did, it's an ultimate flaw hider, right? It's everyone can kind of get in, market's appreciating, hey, financing's relatively easy to come by, everyone looked great until they didn't, right? And I think that is always, as you kind of thin the herd and get some of the, I think the lower tier characters out of it, you've got much more disciplined groups that, the fundraising environment's not easy right now, just across the board. So if you have groups that are well capitalized, they've been through the cycles, they've exhibited the experience and the grit to kind of, get through a challenging period of time. Those are ultimately the groups that, are really active today. And obviously, as I think more deal velocity kind of comes online, those groups are going to, like we said before, are going to be the ones that are initially taking advantage of things. I think, as things kind of stabilize, and, we'll see where the next 2-3 years takes us, you'll have more groups kind of come back in. I'm sure more liquidity will come back in the market as well. But really, I think there's going to be, some level of, the banks eventually are going to have to remark some of these assets and get some of these things off. There's only so much of the pretend and extend game that can go on before things are going to ultimately crack. I mean, you've seen from the securitization guys, when that market dries up, they have to move things around pretty quickly. I think you're going to see some interesting trades take place there. But again, I think you're going to see most of these things initially happen with the very, very well capitalized groups that are going to be taking these bigger trades. And then I think as the system kind of works itself out, as regional banks start to kind of unload, you're going to see more of the a la carte deals that are coming around. I think groups that have, longstanding ties in with some of these banking institutions, they're going to probably get first crack at them. But you're going to see more of them filter through the system. So you will see, I think, more deal velocity kind of move forward. But, it just feels like we've got kind of a logjam right now. You're seeing like spatterings of these things open up. You're seeing, we looked at a deal about 6-7 months ago, and it was a really interesting deal on its face, right? It was an industrial portfolio, had some age sellers that, vintage, call it, late 80s industrials, small units, here and there. Our buyer was a, single family office that owned a bunch of the adjacent units, and the sellers were like, we're not, we were just basically clipping coupons for the last 25 years. so had everything vastly undermarketed. I think it was like they were marketed at like a, $11 a foot modified gross, and the market was really, truly like $11 to $12 a foot triple net. Our guys kind of knew it. They're active in the space. So and the sellers were concerned about the debt financing market. They're like, oh, we got to get out of these things before everything gets really bad. So our guys were looking at it. We actually, eventually I didn't get that deal, but it was one of those. I'm like, wow, this is a really attractive deal for the sponsorship group, because they know they're going to be able to destabilize the vacancy rate in that particular submarket in a 50-mile radius was like sub 3%. So it's like, hey, we're going to, kick out the tenants. You're going to, release up, or you're going to have to go outside of 50 miles to get this through. So it was kind of an educated play. And, they really were going to create some almost immediate value into the asset. And they were getting the thing at a, marginal discount off of face value anyways. So you're seeing those transactions are a little bit harder to come by. I think those are kind of, the borrowers are really digging through the weeds, but I think it's ultimately going to come with, you got those sponsorship groups that are kind of at the end of the road. They were kind of hoping and, praying for significant, rate cuts that would kind of put them more back in the money. And if that's not coming with any more velocity, which, again, we don't believe it's probably probably not going to see any rate cuts, I would imagine, until, probably the tail end of the year, if any. It just kind of puts these guys in more duress. So they're going to have to make some moves. And ultimately it's going to come down to kind of where that bid ask makes sense for the groups coming in.
Yeah, absolutely. Those are all real great. And just kind of aside, because I do want to kind of bring this in for a landing, but especially I've seen with some of my commercial people, the shift from, the lower middle market light industrial space from going from gross to triple net is a huge value add opportunity that I've seen quite a few people go after. And, the nice thing is that you have a market that kind of supports it, with everyone kind of going that direction if they haven't. So, it's not like you're, it's a very easy thing to do. You literally have to do nothing to a property to, again, go from gross to triple net, which I found pretty interesting. I didn't really think it was something that, I thought, industrial seemed to have been this kind of thing that was so set in their ways, but you have operators coming in saying, look, like, this is what we got to do. And the market seems to be absorbing it okay.
Well, and I think, Alex, it goes back to kind of where you're at, geographically where you're located, what that submarket looks like, right?
Yeah.
Because in certain markets, you just really don't have the ability to do that because there's options. But in some of these markets that are tight still, you do. And I think that's just, areas that, when you've got really experienced operators that, again, have a lot of, on the ground, local knowledge, local connections, they understand, and I think those are the guys that ultimately we like to deal with because, this is what they do, right?
I think anyone that's an investor likes to deal with people that are knowledgeable and experienced.
Yeah. And here's the other one too, right? And my partner, Zach, he says this a lot, from the debt side, the hardest thing to underwrite ultimately, because we can underwrite the value of an asset, we can underwrite, projections here and there. The hardest thing to underwrite is the character of the counterparty. And at the end of the day, that was one of our kind of, big, emphasis on why we really, almost focused exclusively on equity funds and single family offices that, again, have real estate divisions, because they have the balance sheets, they've got the experience. In COVID, right, we had one hospitality asset that it was adjacent, kind of near a SeaWorld, right? SeaWorld's closed down for, they say they're going to close for 2 years. These guys own, 40 other hotels. Hey, this one, it's just going to go, it is what it is, and then you have on the flip side of that, if you have somebody that maybe owns one or two, this thing goes bad. They're going to do anything they can to hoard as much cash as they can versus, these guys had dominoes that were going to fall elsewhere. So just kind of the sophistication level. And again, that's us, right? That's just what we focus on. And again, I'm not saying we're right and we're not right all the time, right? But understanding, have these guys work with it. Like what, really like most people had some challenges with their lenders, like how litigious were you? This little things like that, just to kind of get a better sense of like what the lender's going to have to deal with. And then you have to underwrite. And unfortunately these days, in certain states and certain like sub municipalities, again, going back to, gosh, if we're going to look at this deal in this state, well, now if things go wrong for whatever reason, our pursuit costs and our timing on those pursuit costs of foreclosure what does that look like, right?
Oh, yeah.
Because COVID blew some of those things out of the window, man. I mean, it was a different environment altogether. And I think, we're gun shy in a few municipalities. I'm sure a couple of the lenders are as well. So it's just really kind of focused on it. Like, what is your premium if you're going to, even lend in one of those areas? And there's got to be some really interesting compensating factors on it. So it's, again, I'm really, honestly, I'm excited. I'm really excited for what the space holds for the next couple of years. Yes, there's going to be definitely some pain out there on some segments of it. But I think for the groups that are looking at kind of the new world moving forward with new exposure, from our perspective, resetting our exposure downwards with a new lower basis, off a new valuation. I think there's a lot of opportunity for groups out there. It's just, how do you navigate that stuff that you had in between?
Yeah, absolutely. Well, I think that's kind of a great way to end this off. It was a pleasure speaking with you. If you have, and I would also like to make sure people understand how to get in touch with you. If you have people that want to reach out to you to learn more about your firm, potential investment opportunities, or what you have going on, what's the best way that they can reach you over at Pender Capital?
Yeah, best way, probably just go to the website first. pendercapital.com, PENDER capital.com. And it'll kind of direct you to the deal team if you're a sponsor, or if you're on the investment side, unless you kind of direct you over to the investment team on our side.
All right, fantastic. Well, again, really appreciate you being on with us. The most valuable thing that we all have is our time, because can't make any more of it. So thank you for taking the time to spend with us today. Again, this has been the Alternative Investing Advantage podcast. My name is Alex Perny, and we'll catch you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.